Good day, and welcome to the IPC BCP Strategies and Industry Trends for Capital Markets webcast. Today's conference is being recorded. At this time, I'd like to turn the conference over to Jonathan Morton, VP of Product Marketing at IPC. Please go ahead.
Thanks. Hello, everyone. I'd like to welcome you to our webinar on business continuity planning, which will be presented by Alex Tabb from the Tabb Group, and is sponsored by IPC, provider of trading communication systems and voice and data network connectivity. I'd like to say a couple of words about Alex and the Tabb Group. Alex is the practice leader and managing director for the Tabb Group's Crisis and Continuity Services practice, an expert in the field of international affairs with specialization in the developing world, crisis management, international security, supply chain security, and travel safety and security. He joined the Tabb Group in October 2004 from Kroll Inc., the international risk consulting company. Prior to joining Kroll, Alex had a successful 12-year career in the United States Foreign Service. He earned his BS from American University. He's also a graduate from the U.S. Foreign Service Institute, where he studied economics, security, and international affairs. And I also just would like to say a couple of words about the Tabb Group. Tabb Group is a financial markets research and strategic advisory firm focused exclusively on the capital markets. Founded in 2003 and based on the methodology of first-person knowledge, Tabb Group analyzes and quantifies the investing value chain from the fiduciary, investment manager, broker, exchange, and custodian. Our goal is to help senior business leaders gain a truer understanding of financial markets issues and trends so they can grow their business. Tabb Group members are regularly cited in the press and speak at industry conferences and on webinars such as this. For more information on the Tabb Group, you can go to tabbgroup.com. So I'd like to thank Alex for making the time to speak with us today. And before I turn it over to him, I'd like to just add that at the end of the webinar, after we've addressed any questions from the group, please stay on for another couple of minutes to hear very briefly about who IPC is, the types of products and services we offer, and the kinds of BCP capabilities we make available to the financial industry. So at this point, I'd like to turn it over to Alex.
Jonathan, thank you so much for taking the time to introduce me. I want to welcome everyone to today's webinar on business continuity within the financial services sector. And I'd like to get started right away. So today we're really going to focus in on four main areas, which are setting the stage. I want to talk to you a little bit about what's going on, what Tabb Group sees in the market, and how this impacts business continuity. The business continuity challenge that we see today in today's financial services arena. I want to talk about a few case studies in which firms have been confronted with business continuity challenges and how they either reacted or failed to react. And then I'd like to take some questions from folks if they have any. Please feel free to ask questions at the end. I think we're doing questions via the chat interface, which is on the webinar console that you're watching right now. So let's get started right away, and let's talk about setting the stage. What I really want to do in this section is talk about where we see the markets today. And basically, from our perspective, volatility is the word of the day. Today's markets, whether they're equities markets, derivatives markets, fixed income, commodities, volatility is the word of the day. Markets are becoming more connected globally. They're very volatile, and while they're becoming more connected, we're also seeing them become more fragmented, making connectivity even more challenging. This impacts business continuity, and I'm going to talk about that in a few seconds. But I'd also like to say that market performance as a whole is down. We are in tough times as a sector. And I think a lot of folks are seeing that, and it's definitely having an impact on business continuity, on resiliency planning, on a lot of assets and aspects of the financial services industry. So when we say volatility is the word of the day, this is what we mean. Today's markets are just moving at a pace that boggles the mind. If you were to look at the markets 5 years ago, 3 years ago, and if you look at them today, what really strikes folks is the volatility that we see in today's market, and that's due to a number of reasons. And I'm not going to go into all the reasons, but a lot of that has to do with automation within the financial services arena, especially within the institutional capital markets sector. It has to do with things like high-frequency trading, has to do with market fragmentation, it has to do with globalization, it has to do with crises that we're seeing in the overall markets. If you look at the chart that's in front of you, you'll see that the VIX, which is a measure of volatility, while not at its all-time high, which we saw back in 2008, is still at a very high rate, a very high level. And this really impacts business continuity, as it basically says that you cannot afford to miss a beat when it comes to the financial services industry and the markets today. Likewise, what we're seeing is that market participants are using every tool at their disposal to find new sources of alpha and generate new and higher returns. You know, historically, 10 years ago, when I first started looking at the industry here in the United States, we were very focused, of course, on the developed world, the developed markets, which were, North America, Europe, Japan. But today what we're seeing is money and investments are going all over the world. And what we're also seeing is, unfortunately, that the performance of these investments is not what we'd like to see. So the first chart, we're talking about the various performance of individual markets. And you'll see, of course, back in 2008 and 2009, performance really took a hit. And it dropped very quickly, very rapidly. Over the next few years, we saw it grow again. But on the whole, performance has not been what folks had hoped it would be. What we're also seeing in the United States, especially in North America, is that investments are leaving the United States and they're going to new places. We see $438 trillion in equity moving to other locations. And we're seeing capital outflows at a level that we haven't seen in quite some time. What this means is that the world is more connected, that there's more going on, that folks have to be really in tune and in pace with everything that's going on in the markets, whether they're here in the United States, whether in the developing markets, whether in frontier markets. And we're going to talk more about that as we move forward. Likewise, as we talk about volatility, we also want to talk about equity volumes, because a lot of what we're seeing in the equity markets sort of plays out in a lot of the other markets. And, equity volumes have been down considerably over the last few years. Equity volumes have been off every month in 2010, except for May and August and October of 2011. Those peaks, those not off months are going to help, but is it enough to offset what's going on? That's a real question. And the reason I bring this up is because volumes are down, that impacts everything. It really does impact the ability of a lot of firms to generate capital, to generate profitability. And this has an impact on commission rates. And this is where it really has an impact on business continuity. So we see volatility, we see volumes are down, and now what we're seeing is commission rates are down. And commission pools are challenged. And what this really equates to is, in the end, resources. When we see a market like this, what we see in the business continuity, the crisis management, the security, the physical risk, and the operational risk perspective, we see a lessening of resources being devoted to these issues. And that's really why I wanted to present that aspect of what we're talking about, because as resources get more constrained, it's going to be more and more difficult for participants, market participants, to ensure that they have the business continuity and the operational risk controls that they need to ensure that they can sustain their business as we move forward. So what I'd like to do now is talk about how these macro issues, the volatility, the commission challenges, the connectivity, the interconnected nature of the markets impact business continuity and business continuity planning for the foreseeable future. So, from a financial services community perspective, business continuity was really born out of the aftermath of September 11th and the immediate following events. Following the attacks, the community as a whole was really unprepared for a worst-case scenario. Financial services industry, especially in North America, but I think also in Europe and partially in Asia, they had done a lot in disaster recovery. They had done a lot in sort of the basics. But the events of September 11th and the subsequent events, folks here in Europe will remember the anthrax attacks, they'll remember the blackout that was a few years later, really showed how they weren't really ready for a much larger worst-case scenario. There were very few thought-out plans that really took into consideration mass area events or calamitous events. There was a lot of focus on the failure of institutions to properly plan their critical data infrastructures. Data centers were either located right adjacent or within their primary facilities or directly across the street. There was little thought given to how folks are going to work in the event that they lost their facilities. There was little thought given to the impacts on communications, workflow, power, facilities management, all the nuances that everyone needs that relies on to sustain and really move their business through on a day-to-day basis. And this was really brought to bear after the events of 9/11. No one had really thought about this stuff. And so following September 11th, there was a great deal of focus and a great deal of effort and a great deal of resources put into this. And this was definitely the case when it came to the buy side and the sell side and the exchanges. They immediately recognized the flaws in their previous sort of planning paradigm and invested a significant amount of resources, manpower, time, and money to develop continuity plans that were pragmatic, realistic, and capable of sustaining their operations in the worst scenario. But today's world and the world of post 9/11 are very different, and I want to go into that. Business continuity has changed an immense amount from the days before September 11th to immediately following September 11th to really the market crash of 2008 and 2009. If I were to say the two sort of most important factors in business continuity planning in the recent years, last 10 years, last 12 years, have been the events, of course, of 9/11, but I also say the market crash of 2008 and 2009. Because prior to that, everyone was focused on, okay, what's the worst case scenario and how can we make sure that we're prepared for that? So the post 9/11 environment, there were a lot of major trends that occurred. There was a push by institutions, push by organizations to institutionalize BCP within the financial services arena. Every major sell-side firm, every major buy-side firm, every major exchange, and a lot of the technology providers recognized the importance of business continuity, and they devoted a lot of resources to it. They created high-level standards requiring significant investments, and they focused on the technology and the information, the people, the communications, the management, and they really focused on how can we ensure that we can sustain our operations. From a macro perspective, institutions were looking to ensure not only the safety and security of their people, but their systems and their people. There was a strong focus on IT technology and data center technology. There's also a lot of focus on connectivity to the markets themselves. How can we ensure that we can sustain our connectivity to the individual exchange, whether it's the NASDAQ, New York Stock Exchange, whether it's connecting in London, the London Stock Exchange, or in Japan, to wherever it was. People wanted to make sure they could sustain that connectivity. That was a big issue following September 11th, and a lot of money, a lot of resources, a lot of manpower were focused on these issues, and some really interesting solutions were developed, some great technologies were developed, and a lot of really useful ways of confronting these challenges were explored. From a micro trend, sort of post 9/11, there's a lot of regulatory effort. After the attacks of September 11th and the following events, a lot of the SROs, the self-regulating organizations, a lot of the government organizations, a lot of the exchanges created a whole host of guidelines, best practices, and rules. The SEC came out with the Treasury and came out with a whole series of guidelines to the United States on what they wanted to do with business continuity. At the time, it was NASD, but it's called FINRA, came out with Rules 3510 and 3520, which mandated continuity practices for important organizations and for organizations that were part of the NASDAQ board. And what was there? New York Stock Exchange came out with Rule 446. The FFIEC, which is the regulators, came out with the BCP handbook. The FSA came out with a BC practice guide. Of course, the Australians and the Japanese, everyone came out with a whole host of very stringent regulatory requirements for organizations that they felt were critical to the survival of the financial services practices of the financial services communities. What's important to note, though, is that these were very limited in their scope, and they did not apply to everybody. There was no law written in the U.S. legal institution that said every firm had to do this. They were targeted rules and targeted regulations for financially important institutions. Really focused a lot on the exchanges, on major sell-side institutions, and the largest of the large buy-side firms. From a standards perspective, we saw a lot of activity also after 9/11 in which a whole host of SROs developed standards which people should follow, whether it was the BS 25999, sort of business continuity management codes, or whether it was the ISO or PAS standards. Even organizations like the NFPA, which many of you may not know, which is the National Fire Protection Agency, came out with standards, as did various independent organizations like As Is, which is this institution, the American Society for Industrial Security, and the Business Continuity International Organization. So there's a lot of effort to put in regulatory requirements to ensure that people were following business continuity practices. We also saw, following the 2001 events, there's a massive effort in looking at worst-case scenario practices. What are we going to do in the event of a worst-case scenario? But then we sort of after developing all of these worst-case scenarios, things were humming along fine. Everyone had their business continuity in place. There was normal routine of drills and training. And then we were confronted by the crash of 2008, 2009, and that really changed a whole heck of a lot. That changed everything. Because what happened was, prior to 2008, 2009, people were worried about sort of, okay, what's the worst case scenario? Even if it's a low likelihood, we have to plan for it. And what the events of 2008 and 2009 demonstrated quite clearly to everybody that, it's great to think about the worst case scenario, but when my business is failing, when we are facing a massive economic crisis, you know what, worrying about if an asteroid is going to come down and strike New York City is great and fine, but what I really have to worry about now is keeping my business afloat. And so before the 2008, people were focused on the major threats and the major challenges. But after, what we see today, and this is important, is that folks are no longer so concerned about the grand what-if scenarios. Yes, they are concerned about, major climate events, the tsunami in Japan. They're concerned about the tsunami that hit East Asia. But what they're really concerned about, especially in the financial services industry, is how can I make my organization more robust and more resilient, and at the same time enhance efficiency and provide folks with ubiquitous technology and processes and procedures that can allow them to work from wherever they are. And so what this meant was that following 2008, 2009, from a planning perspective, almost all the regulations are similar in nature. Things are still the same, but folks are now focused on a different area. And what they've recognized, first of all, is that not every organization is created equally. That organizations have to develop their own business continuity strategy, their own business continuity plan based on their requirements. And they need to identify what is driving their business continuity. What makes it important to them? Individual organizations are now recognizing that everyone is not created equally. And that to create a really strong, holistic approach to business continuity, you need to focus on really what we call the incident response continuum, which is a holistic approach, which really focuses in on from the start of when an incident actually occurs all the way through to crisis management, which has to do with decision-making in a crisis, all the way through business continuity planning, disaster recovery, and then resumption. And, for most folks, what this requires is a series of planning assumptions and planning efforts. And that really starts initially with, okay, a risk assessment, a threat assessment. What are you concerned about for your organization? It really has to do with developing a good analysis of, okay, what is the impact of failure for us? What are we trying to alleviate? What are we trying to protect? What are we trying to ensure continues to work? What is most important to us? What is the cost of failure for us? And that doesn't have to be in a dollar and cents sort of manner. It doesn't have to be, well, if this certain technology or this element fails, it's going to cost me X amount of dollars. That can be a very powerful driver. But more importantly, it's important to understand on a macro perspective what that means for your organization. It also means focusing on disaster recovery. It means focusing on crisis and incident management, understanding how people make decisions and how they communicate. And then finally, it really focuses on training, testing, and maintaining any plan that you develop. Now, from our perspective, one of the things that we think is really important is to understand what is driving your business continuity efforts. Why are you so, what is important to you? What is it? Is it a regulatory concern that you're worried about? Is it an operational concern? Is it an investor concern? Is it a mandate from compliance? Understanding those things are very important. And what I'd like to do is to ask everyone, I'm going to push a poll out to everybody and see if folks, if we can ask a question to folks, what is driving your interest in business continuity today? Is it a regulatory requirement, compliance? Is it investors? What we're seeing today is a big push by especially some of the larger pension funds and larger investors that they want to make sure that the people that they're investing with have a full, robust, resilient business continuity capability. Is it an overall concern about risk, or is it something else? Please, if you have a moment, please take a second and sort of give us your response. We'd be very interested in hearing what you have to say. And see. And I'm going to pull up the results and see if we can do this, if I can figure out how to do this. Hold on one second. Sorry. Interesting. What we're seeing now is from the folks on today's call, 66% of folks are saying that they're really concerned about risk as a continuum, I imagine, all aspects of risk. We do have some folks who are interested in are driving by regulatory requirements and compliance. Some are saying investors, but risk is the biggest concern, and that makes sense because today, especially following the 2008, 2009 crash, risk is a major driver in today's marketplaces. So let's continue on with the presentation, if that's okay. So I want to talk now about really sort of what folks should be looked at, what folks should really focus on when they're looking at business continuity. From an operational perspective, participants need to focus on the reality of creating a pragmatic approach. This is a big thing that we found after 2008, 2009, that pragmatism rules the day. Resources, as we talked about before, resources are not, organizations are not as flush with cash as they were, back in 2004, 2005. Times are tight. So folks have got to develop business continuity capabilities that are pragmatic. And to do that, what we suggest people really focus in on 4 main areas: people, technology, information, and communications. And we talk about people, we're also talking about, in the macro, facilities, work environments. We talk about technology. We talk about hardware and software. Information. Let's not forget that technology is great, but without information and how you manage that information, technology is rather useless. And then communications. And when we talk about communications, it's not just about data and voice, but it's also about internal and external communications. Communicating within your organization so you know what's going on, that people are aware of what they need to do and that they get the work done properly. But it's also about talking to your customers, talking to your vendors, talking to your partners, to your investors to make sure they know what's going on. So let's look at people. From our perspective, when we talk about business continuity planning, when we look at people, we really want to look at 3 main factors: roles and responsibilities, processes, and technology. Now, you must forgive me. I am a process person. I think if you are going to make sure that you have a robust organization, what's important to know is how people do what they do. Understand the process. If you understand the process and you understand what's important about a process, you can make sure that you can replicate that process. And replicating a process doesn't mean that you have to always do the exact same thing. So if prior to a disaster you're doing something A, B, C, D, after disaster, you don't have to do it A, B, C, D. What you need to understand is what is important about that process, who drives that process, what the technology is that those people need to drive that process, and how to get that accomplished in as pragmatic and appropriate a manner as possible. Ensuring that you have the proper operational controls, that the proper management is available to these individuals, as well as the proper direction that they need to sustain their operations. When we talk about technology, we tend to focus on 2 things as well, which is hardware and software. It's important to remember that when we look at technology in and of it by itself is rather useless. You need the people, which we talked about, who can use the technology, and you need the technology to work. So you need what drives the technology, which would be the software. And when we talk about hardware, we also oftentimes will talk about disaster recovery strategies, creating a strong and robust disaster recovery strategy with failover capabilities and alternate data centers and alternate work sites available for individuals and technology, so that that technology in the event of disaster can be utilized. And this is not just a business continuity challenge. This is actually a day-to-day challenge. Oftentimes, in a lot of organizations, technology has gotten so complicated that you need a robust infrastructure. You need the capability to fail over to other servers. You need the capability of failing over to other communications lines. When it comes to technology, we also want to make sure that we understand who our hardware suppliers are and our vendors. Oftentimes what will happen in a disaster, the equipment will be damaged or destroyed or will be inaccessible, and we will need to find out who provides the critical equipment. How do we get it drop shipped and get it to our new location as quick as possible? The best way to do that is to take technology inventories, to know who your suppliers are, to know who is out there who can get you what you need and get it to you quickly. It doesn't mean, so if you're a high frequency trading shop and you're co-located in an exchange and you've got millions of dollars invested in a co-location strategy, oftentimes, and we heard this from one of our colleagues who is involved in this types of environment, that they said, yes, we have invested millions of dollars in a high-frequency co-location strategy. We recognize that in the event of a disaster and that primary location where our co-location strategy is actually physically located, if that goes down, if that's destroyed, we do not have a replicated version of this in their backup data facility. And it's not because, the exchange was going to charge us so much money. The real challenge was that it was the equipment necessary and the manpower necessary to sustain a completely duplicate infrastructure in a location that for most folks is never going to get used 99.99999% of the time. What they did is they did a risk assessment, a business impact analysis, and they said, you know what, we recognize if there's a disaster and if the exchange loses its primary data center for whatever reason, whether it's a natural disaster, a fire, or a power blackout that is so long that they can't get fuel for their emergency generators, what they have said is, we, as a firm, will take that. We know all the equipment. We've inventoried it all. We have worked with our vendors and suppliers. We know exactly what we need to replicate that capability in the backup data centers whenever it needs to be done, and we can do that in 3 days. And we can take the hit for 3 days while we rebuild that infrastructure. To them, the millions of dollars it would require to sustain an infrastructure or duplicate infrastructure just wasn't worth it for them. So that is part of this whole idea of understanding where your hardware requirements are. The same is true with your software requirements. Understand what people need, what software folks need, what technology they need. Understand what software you need to drive your infrastructure. And once you understand that, then you have a good technology basis to create your continuity plan around technology. I also like to talk about information, data. Today's markets are driven by data, whether it's market data, reference data, internal data, risk data, data. Information is the lifeblood of this industry. Understanding where your information is, understanding how you utilize it. We also have to remember that not all data is soft data. Not all data is in computers or is in the cloud or is stored somewhere. Oftentimes, a lot of organizations will have hard copy data. Understanding where that data is, understanding where that information is, how to get to it, how to protect it, what is critical, what is important, what can be copied, what needs to be taken off-site to a repository, what do you need access to at any given time. Understand how the data fits into your processes. Then you can create planning about how to ensure data resiliency and to make sure that your overall data infrastructure is protected in the event of a disaster. Likewise, data centers. Following September 11th, we recognized as an industry that you can no longer just keep all your technology and primary processes and primary workspaces co-located in the same infrastructure. Now what you see is most of the major firms in New York, most of the major firms in London, what they'll have is they'll have primary and secondary work locations, but they'll also have data centers which are usually located off-site. Now, yes, it's true that this was also done for a business continuity disaster recovery capability. It was also done for an economics capability. Let's face it, putting a data center in Class A space in New York City in Midtown at $85 a square foot versus putting a data center in, I don't know, Hoboken or in, Westchester County where you can get it for $12 a square foot makes a lot of sense. And in today's business continuity environment, that's really a key driver when you're trying to sell your internal business continuity capabilities to your leadership and the folks who are going to spend money. If you can justify it through savings and cost-effective nature and improving operational capabilities, you're much more likely to get it funded and to move it forward in today's environment. Finally, I want to talk about communications. Communications is really a key element of business continuity. And there are two sides of the communications, and each side has to deal with data and with voice. Communications via data, we know the importance of data. Data is the lifeblood of the financial services industry. But voice is also important. People need to communicate via voice, especially internally, especially with your clients and your partner organizations and your investors. Being able to effectively manage your processes means you need to be able to communicate. When it comes to data connectivity, it's really important. It means that you have to have a robust and resilient infrastructure. It means you need to have primary and secondary lines, connectivity lines. You need to make sure that these lines are routed via different switches and different POPs. You need to make sure that you can manage the failover of this. And there are many ways to do it, whether it's through organizations like Extranets, financial services Extranets, which are very important in the financial services industry. Extranets are great because they tend to manage that capability for you. But also, if you have your own direct point-to-point communication networks, it means making sure that when you create a point-to-point network to a critical partner or a critical client or an exchange, it means that you need to make sure that you have two separate lines running to the primary and secondary location, that these lines are going through different POPs and different infrastructure sites. So if you lose one, if something happens, it means you don't lose two. Likewise, for voice, you want to make sure that you know how to communicate with all your partners. You need to make sure that you have a complete repository of information on how to communicate through voice with individuals. On a trading floor, it's great that everyone has turrets. We all have trading turrets with, massive Rolodexes built into them. But it's also important to make sure that in the event you lose your trading floor, your infrastructure, that information is captured somewhere else and can be forwarded to whoever an alternative worksite may be set up. So I'd also, at this point, like to push out another poll to folks to say, for individuals who are concerned about business continuity, I'd like to ask you, from your perspective, what's the most important aspect of business continuity planning that you're looking to try to see? Is it, are you really mostly concerned about people? Are you worried about technology? Are you worried about data information? Are you worried about communication? Are you worried about all of these things? Are there any primary areas of concern that you have when it comes to business continuity planning? All of these are very challenging. But the one thing that we tell our clients when they start working on these topics is we find that it's best to take a look at the individual topics and to take small bites of the apple, individual, small steps. Identify what's most important with an individual topic and then look at it and say, okay, little baby steps. Let's take a look at this little aspect and take a look at this little aspect. And by doing it that way, you can create a comprehensive business continuity capability without having to, create an environment where everyone is consumed by it. No one has the time these days to devote massive amounts of resources to creating continuity plans that are so large, that are so unwieldy that in the end they're really not going to be very, very effective. And as I suspected, I was just looking at the results. I'm going to push the results to everybody. But pretty much people are concerned across the board. Data information is important, but all of the above, and that's sort of what I figured. And so the key aspect that we try to tell our clients is small bites of the apple. Look at what's important with each element, and try to figure out what is the process that you're trying to recreate. What's the technology behind it? Who are the people that need to sustain that process? How can we communicate with those people? How do we make decisions? And how can we make sure that that process can be replicated in the event of a disaster? So I'd like to move on now to some case studies. I want to talk today about two individual case studies that we ran into over the last few years when we were working with some clients. And when it comes to focusing on what's important, the best way to develop a pragmatic approach to continuity is to really focus on what you need as an organization to sustain your operations. Participants, market participants, need to understand what is important to them in terms of their responsibilities, their risks, what processes do they need to sustain, what would happen if we lose those individual processes, what technology do we need to sustain our operations, how do we test to make sure that the plans that we have created work, how do we ensure that those plans are maintained over time, and how do we ensure that the proper operational controls are in place so that in the event of a disaster, we can make sure that we are doing what needs to get done to ensure that our clients and our customers and our regulatory responsibilities are all being sustained. So from a case study perspective, I'd like to sort of bring these home with two different case studies. The first case study, we're going to look at a sort of a large buy-side firm that was located here in New York City, and their challenge was to create a pragmatic approach to business continuity at a reasonable cost that did not sort of take up everybody's time, and that was driven by investor mandates. They were looking to go to the street to raise money, and their investors demanded they have a robust risk program, both financial risk, operational risk, and to sustain their operations and protect their investment. And the second case that I look at is sort of a different spin on this. And this is a multinational treasury organization located in Washington, D.C. And this is what happens, in this case today, I want to look at what happens when the best intentions go awry. And this was an organization that had created a business continuity plan, but it was cumbersome, it was poorly thought out, it was not well communicated, and the impacts of what happened to that organization when a small event almost turned catastrophic for them. So in the first case, what we had was an organization, and this happened in the last couple of years. They were looking to go to the street to raise approximately $2 billion for a new fund. And their investors were demanding that they do a thorough risk analysis of the firm and to have a comprehensive business continuity crisis management program in place before they would invest a lot of money. The challenges that this firm really had was this was a very lean and mean organization. These were very busy individuals who were managing massive amounts of money, and they did not have a great deal of time to devote to this. Also, they didn't want to spend a fortune. As I said, they wanted to do this for under $150,000. For them, it was that investment was what they calculated, which is what they could afford and what they wanted to spend on making sure that they had a plan. But they needed the plan to get the money so that they could fund this new fund. The timing was an issue for them. They didn't want to waste their staff's time. They didn't want them consumed by endless series of meaningless meetings where people were sitting around the table just talking. What they wanted to do is they wanted to get in, they wanted to develop a plan that was pragmatic, that got them what they needed, that would ensure their business continuity, and get out. This was a firm that was heavily dependent upon technology, but it was a lot of desktop technology. It was not a lot of enterprise technology. They had been smart enough over the last few years to go to a lot of technology that was in the cloud. So for their enterprise solutions, they were fairly confident that their enterprise solutions were in good shape, but they used a lot of desktop technology, a lot of spreadsheets, PowerPoint, Word documents, individual applications which they needed to make sure were resilient. And they were also very heavy on communications, both internally and externally. They were managing folks' money, lots of money, billions of dollars, and they needed to make sure that they could sustain communications. From a solutions perspective, they wanted to make sure that they had buy-in. And what they did is they achieved buy-in by doing a top-down process. Leadership weighed in and said, this has to get done, and everyone fell into line. Timing. To really sort of confront the timing issue, what they did was they made sure that the meetings lasted no longer than an hour and a half, that folks went into the meetings fully briefed, that we as the practitioners got what we needed and then did the heavy lift so we weren't consuming people's time. technology, they wanted to make sure that they invested in technology to enable productivity, no matter where their people may have been. And communications, they put an early focus on communications. They developed a methodology to make sure that in the event of a disaster, they would have robust communications capability no matter where they were. They also made sure that they knew how to contact each and every one of their clients in the event of a disaster, and they had developed a very, very, very crisp plan for ensuring that in the event of a disaster, they would reach out to all their investors within the first 24 hours to give them briefings, and they set up mandates that communications would flow after that. They recognized early on that communications was the key. And with that, they also did a pretty heavy analysis of how their communication structure was designed. Initially, what they had developed was a communication structure where they had individual desks contacting multiple organizations to manage their money. And what they decided was, during the continuity planning effort, that this was just too difficult to maintain. It was too complicated. It was too expensive. And what they moved to more was an extranet sort of solution, a cloud solution, in which instead of running all these different lines, individual locations for private lines, what they did is they connected everybody up through this sort of communications cloud environment, and they were able then to do with one vendor to deal with, okay, we're going to deal with this one vendor who's going to manage all of this. We're going to lay off all this complicated technology onto them. We create strict SLAs to make sure that everyone understands what the responsibilities are. And then we can make sure that we can communicate both via data and voice to everyone we need to communicate with. And it was a very successful strategy for them. They were able to do this very quickly with not a great deal of upfront capital investment, and they felt that they were able to sustain their communications agenda without sacrificing anything. I'd like to move on to case study 2. And case study 2 is a different type of case study. This case study, we're going to look at what happened when this sort of multinational treasury organization ran into what was considered at the time just a minor fire. What happened was, outside their primary data center, which was also one of their primary facilities, a small electrical vault, which was run by the DC power company, exploded. It was a small fire that occurred right in front of the building. No one was hurt, no one was injured. But at 9:50 in the morning, this fire occurred. It lasted all of 10 minutes. There was actually no real flames. It was just smoke, lots of smoke. Unfortunately, the fire was situated right next to the air conditioning intakes, the vents that took in all the air for the facility. And as the smoke sort of came out from the vault, it got sucked up into the air conditioning vents, and it got distributed throughout the entire building. So within a minute or two of the fire, everyone in the building was panicking because they smelled smoke. And what happened is they immediately evacuated the building. But no one would communicate with anyone. No one told leadership what was going on. Someone just said, okay, someone on the street said, we're going to evacuate. And they evacuated everything. So they evacuated their primary data facility. They evacuated some of their primary office facilities. They evacuated all the executives. And everyone ran out into the streets. Now, there was a very clear-cut plan on how people were supposed to evacuate and what they were supposed to do. Unfortunately, no one really took the time either to train the individuals in the building or to disseminate the plan properly, so nobody knew what to do. And what we had a situation in which security was trying to herd sheep, leadership was trying to understand what was going on, and in a matter of minutes, chaos ensued. If we look at a timeline of the event, soon after the fire occurred, first responders arrived on scene. The building was evacuated. Smoke started being reported inside the building. The building was evacuated. And lo and behold, a senior administrator from this organization, who was not really supposed to take command, decided he was going to shut down all of the air conditioners in the entire facility, because he didn't want the building damaged by smoke. He thought it would cost too much money to have smoke in the building, and he didn't want to damage any of the furniture or any of the carpet. So he decided to shut down all the chillers. Unfortunately, he failed to take into consideration the fact that the chillers were there mainly not for the people. The chiller plant was there mainly for the main data center. And this data center powered the organization's entire IT infrastructure. This organization had offices in over 120 countries where operations were on a 24-hour basis. And lo and behold, everyone was evacuated. No one was in the building. The air conditioners are shut down, and within 5 minutes, the heat and the data center started to rise, and it started to rise very, very, very quickly. Within 10 minutes, 15 minutes, 20 minutes, temperature spikes were being read in some ancillary data centers and the primary data centers, and lo and behold, servers started to shut down automatically. Leadership initiated an emergency failover, which wasn't successful. And before you knew it, all of a sudden their network operations center, which was in another facility, was getting calls from satellite offices saying, why is our technology not working? We're losing communications. We're losing access to critical infrastructure. Fortunately, they were able to restart the chiller plant and get things moving before they had a complete system-wide failure. But lo and behold, what really happened was because people were not aware of the failover nature of continuity, of the importance of communications, leadership took inappropriate actions, not understanding the consequence of these actions, which almost had a disastrous effect on the institution as a whole. The reason I wanted to bring this up is because in an after-action report that was conducted soon after this by the institution, within a couple weeks of this incident happening, they recognized that their existing continuity plans only dealt with catastrophic events. They didn't deal with sort of localized events. This was a very small localized fire, yet it had a massive impact. While the plans existed on what to do, nobody knew about them. No one knew that these plans were there. No one had been trained on it. People weren't aware of what their roles and responsibilities were. People weren't aware of the importance of this data center and what would happen if all of a sudden you turned off the chiller units. They recognized that you can't co-locate your primary data center with leadership and critical mission staff all the time in an urban environment that's only a few blocks away from the White House. It was just a poor facility staffing plan. Failure to adequately train their personnel was disastrous because people didn't know what to do. They had no real knowledge on what the consequences of their action was. And that in the end, they needed to reassess their continuity planning. They needed to be more focused, more pragmatic, and they really needed to ensure that they trained people on the basics. If you train people on the basics, overall they'll do a much better job when it comes to the big things. And so I really want to sort of wrap up today's presentation, sort of take away a few takeaways that we think are important if you're looking to try to develop a continuity capability within your organization, especially in today's market environment. And as we said in the beginning of this presentation, markets are moving super fast these days. Automated trading, electronic execution, global connectivity, market fragmentation, all these factors really drive home the importance of maintaining your operations in the worst of environments. Because if you're out of the game for even the shortest amount of time, it can have a disastrous impact on your organization as a whole. It could impact not only your operations, it can impact your performance, it can impact your relations with your customers and your clients and your partners. So sustaining business is a very important aspect of overall risk planning. But at the same time, firms have to be cognizant of the fact that, we need to do this on the reality of today. We can't spend a fortune on this. We need to be pragmatic. We need to develop technology and processes and procedures that enable resilience, that enable robustness, that enable effective organizational efforts. And so, today's world is moving very fast to ignore business continuity. Global connectivity and the 24-hour trading day necessitate continuity, disaster recovery, risk management. Not all firms are created. When we talked about all those organizational efforts, all the standards that were developed, all the regulations, those do not apply to everybody equally. If you're a tier 1 sell-side firm, if you're an exchange, you have different responsibilities than if you're a small hedge fund or you're a medium-sized, long-only equity shop. Understand your responsibilities to your clients, to your customers, and also your regulatory obligations. That's where you need to start your planning perspective. Clients and customers are becoming more savvy, and they're looking for holistic risk-based approaches. Make sure you look at the entire picture and what's important. Don't forget about the importance of communication. Communicating internally and externally is really critical. And while it doesn't seem like a big deal, I'll just pick up the phone, you need to understand how your organization communicates, how it moves data back and forth, how it moves information back and forth, and then really plan on that. And finally, don't forget, people are the most important things. That's what makes your organization work, but also technology, information, and communications. It is a four-legged stool, and you really need to focus on all aspects of that. So at this stage, I'd like to ask folks if they have any questions. We're coming near the end of our webinar, but if you have any questions, please be so kind as to use the interface here. If you have any questions, I'll be happy to answer a few questions. You can submit the questions on the interface. And let me go to the questions area and see if we have any questions. Okay. I've got a question here. When it comes to connectivity, what are the most important factors that need to be considered when developing business continuity plans? Well, the important factors that I think are really making sure that you understand who you need to be connected to. Prioritize connections. Understand that different people have different connectivity requirements, and that you need to make sure that you, in the event of disaster, can failover properly, that you have proper failover capabilities, that your connectivity infrastructure is capable of sustaining the data transfers and the messaging and the communications infrastructure that you need. So if you're connected, if you're a long-only money manager in Connecticut, and your primary person that you need to be connected to is your broker, make sure that you have multiple ways of ensuring that you can make sure that your people can communicate with your broker, that your technology can communicate with your broker. Likewise, if you are a sell-side firm and you want them to connect to exchanges, you need to connect to market data providers, you need to connect to your clients, that's a different strategy, and you need to make sure that's enabled as well. I've got a question here. How can firms motivate their management staff to participate in tabletop exercises? Understand their importance. That's a very challenging aspect, especially in today's environment. What we like to do is we like to try to remind people, A, of their responsibilities. They have a responsibility to sustain their operations during good times and bad. That they're not only rewarded for doing things when things go well, but they're also responsible for making sure things go properly when things are not going well. We also find, and this is a horrible thing to say, we also find bribes really help. When we run exercises with staff, we always make sure to schedule it well in advance. We always make sure to provide folks with trinkets and thank you notes. We make sure we provide them with food. We always try to give them sweets. We try to make it as contained as possible. We try to make our exercises very focused. We try not to make them too long. So for us, we like to do a tabletop exercise no longer than 90 minutes for the actual exercise, and then usually a half an hour for a after-action sort of discussion. We like to make sure that it's a focused exercise looking at sort of one process or one technology or one scenario. When you start adding more and more groups and it starts getting larger and larger, that becomes a more challenging aspect. And the best way to motivate folks is, once again, to get senior-most buy-in, to get leadership to say this is important. That's a responsibility that you have to take very seriously. At this stage, I think I'd like to thank everyone for the participation. I'd like to turn it back over to Jonathan, who I think is going to talk a little bit about IPC and the IPC organization.
That's great, Alex. Thanks very much. Yeah, I appreciate you guys sticking around for just another few minutes. What I wanted to do is to wrap up with a little bit of information about IPC and some of the products and services that we offer. IPC is a leading provider in trading communication solutions, and that includes not only the traditional turrets that traders and sales traders use to talk to their counterparties, but it also includes a whole range of collaboration solutions to facilitate and streamline communication with the trader. So trader to portfolio manager to research analysts and to the compliance teams. And as well as not only the collaboration solutions, but also productivity applications to make the trader more efficient and more productive, and ultimately to generate more revenue. The other part of our business is a voice and data network connectivity business, and We operate a global managed network dedicated to the financial community, and that includes both voice services for private line connectivity for firms, as well as a variety of different point-to-point and layer 3 routed extranet type of connections and extranet capabilities. So really to give firms access to a whole range of trade lifecycle services and applications. So those are really the two areas that IPC focuses on. And just to, obviously in the theme of today's webinar, we have a whole host of solutions that are geared around providing BCP capabilities to our clients. And I won't go through all of these in detail, but I do want to mention just a few on both sides of the business. So in terms of trade and communication solutions, IPC offers remote access and also soft turret capabilities, so the traders, as Alex was talking about earlier, really gives traders access to their communication tools wherever they are, whether they're at their production normal office or at home or an alternate office. Really, these tools are designed to make sure that they can stay productive, stay connected to their clients, and keep doing business. And of course, along with that, there's a host of other types of solutions like turret redirect capabilities so that the turret can be connected to an alternate back room. And another thing that we see a number of clients doing that I think Alex touched on was a dual data center type of architecture, which has multiple trading floors in a region connected back to redundant data center capabilities with access to lines shared between them, so that even if there's a problem in a data center, trading floors can still gain access to the private lines, and those traders can stay connected to their counterparties. In terms of the data connectivity, we have a host of capabilities for both voice and data. On the voice side, we have a carrier redirect functionality that allows private lines to be redirected to an alternate site, and a little bit more of advanced capability of enhanced voice service, which means by leveraging IP technologies, we can actually make private lines available at multiple sites simultaneously, so that lines don't have to be redirected. They're actually available all the time at both a production site and at one or multiple either disaster recovery or alternate locations. And that's an increasingly popular way to make sure that those lines are available wherever the traders go. And then, as you can imagine, we've also got a variety of capabilities in terms of dual and redundant link from the network to the client sites, dual POP delivery with either single or dual routers at the customer premise. So that just gives you a flavor of some of the solutions that IPC makes available with regards to BCP. So I wanted to thank all of you for joining us today, and we look forward to speaking with you soon. Thanks very much.
That does conclude today's conference. Thank you for your participation.